Hey guys, this is your host Nitin Binhani, and a very warm welcome to my startup podcast channel Jazair Audio, where we share real stories with real learnings.
In today's episode, we'll delve into a topic that's often hyped but may not be as promising as it seems. We are talking about the initial public offerings, or IPOs. IPOs are considered as the golden ticket, a chance to get a stake on another Google or Microsoft, but the reality is much more complicated and perhaps less profitable than it appears to be. So stick around as we explore whether the Indian SME IPOs are overrated or overhyped. Let's start with the basics. IPOs are when private companies decide to go public by offering their shares on the stock market. IPOs have two main purposes. A, to access equity capital for expansion, working capital, or high debt repayment. B, to provide liquidity for early investors and promoters. It's a natural growth path. Companies want to raise capital to expand, and, in return, they give investors a chance to buy in or become shareholders. However, India's market regulator, SEBI, recently raised a pretty big concern pertaining to how retail investors are approaching the SME IPOs. It even issued a warning to investors about the risks associated with overly optimistic company portrayals. Statistically, 54% of SME IPO shares allotted to retail investors are sold within just a week. It's pretty clear that the retail investors subscribe to IPO simply to make a quick buck on listing gains. This mindset brings us to something even more troubling: the excessive hype around SME IPOs, which are often much riskier and far more opaque than the usual big-name IPOs. Experts believe SME IPOs can be easily manipulated, and the information shared is often less transparent. Let's take the case of Resourceful Automobiles, a relatively small business with just 2 bike showrooms and 8 employees. When they launched their IPO, it was oversubscribed by a whopping 400 times. The company was looking to raise just 12 crore or $1.5 million, while they got applications worth nearly 5,000 crore or 600 million. So are the SME IPOs overhyped? We outline 4 key points to support our hypothesis. 1. Valuations may be too high. Promoters of private companies usually launch IPOs when demand is high, that is, during a raging bull market. A hot market commands higher valuations, which allows the promoters to price their shares at a premium. It's a great deal for the early investors and promoters, but for retail investors, it means they're often buying in at inflated prices. So while the insiders cash in, those buying at IPO might be paying too much, often just for the chance at a short-term gain. But when the bull market loses steam or ends, that's when we see corrections, which often leads to far lower returns over the long-term horizon. 2. You may simply be the greater fool. Let's talk about the greater fool theory. The idea here is that you can profit from buying something overpriced as long as there's a greater fool out there willing to pay an even higher price later. And that's exactly what's happening with many SME IPOs in India. While it's completely fair for early investors, such as VCs and PEs, to demand a return for their risk, the problem comes when the purpose of the IPO is to solely benefit the early backers or investors to cash out. In such cases, the retail investors are simply stepping in as greater fools, buying at a high price, and hoping that they can sell even higher. It's noteworthy if the promoters are selling a large stake, and if they believed the share prices were going to skyrocket, wouldn't they hold on a bit longer? Number 3. Listing gains aren't a certainty. We've all heard the stories about someone makes a quick fortune on the first day of trading. But here's the reality check. Those listing gains aren't guaranteed. According to a KPMG report titled IPOs in India, somewhere between 20 to 35% of IPOs actually end up with negative listing gains, even during a bull market. Betting on a quick profit can be more of a gamble than a sound investment strategy. You might be better off leaving that to the day traders who are ready to handle that kind of risk. Number 4. Listing gains are mostly insignificant to your portfolio. Let's say you do manage to hit the jackpot with bumper listing gains. Will it truly make a difference to your financial well-being? In most cases, these gains are too small to make a noticeable impact on your overall portfolio or net worth. Sure, it might feel good for a moment. You might even get some bragging rights at a dinner party. But that's where the value ends. It's a short-term high, not a sustainable investment strategy. Bigger picture, it does little to support long-term wealth creation. Key takeaways. IPOs can be tempting, especially with all the hype and excitement around getting in early. More often than not, Retail investors are stepping into a game where the odds are stacked in favor of the insiders, the promoters, the early investors, the institutions. If you're considering an IPO, take a step back and evaluate why the company is going public. Is it to grow and expand, or is it to give insiders a way out? Remember, true growth isn't about chasing quick gains. It's about long-term, sustainable value. Instead of getting caught up in IPO fever, focus on building a diversified portfolio grounded in companies with solid fundamentals and a long-term vision. That's where real wealth is made. As we wrap up, I hope this episode reminds the listeners to take a more grounded view on IPO investing. Remember, true growth is steady, sustainable, and strategic. Thanks for listening, and until next time, keep growing wisely.
And with this, we have reached at the end of this podcast. Thanks for your valuable time, and please like, comment, and share.